If you are keeping all your money tied up in a local currency, you are playing a losing game. You need to step outside local volatility and start earning in dollars. In today's video, I am showing you exactly how the big players do it using Eurobond. Welcome back to This Space, your ultimate guide to smart investing and wealth building. Let's get into it. Now, what's the concept of a Eurobond? I'm going to break down the mechanics in this video. I want you to focus on the figure on the right hand side. At the core of it, you see a Eurobond. It's simply a debt instrument that an entity issues in a currency completely different from the local currency that you operate in. Don't let the euro prefix confuse you. These assets are usually denominated in the US dollars. This mechanics allows emerging markets, governments, and corporations to tap into massive global liquidity pools. In the case of the government, they get to raise large-scale capital for things like infrastructure or covering fiscal deficits. And in exchange, you, the investor, get paid a fixed, highly predictable dollar-denominated interest over a set time frame. These interests are usually called coupons. Now, why do I think this should be part of your portfolio? Holding your assets in Naira right now exposes you to severe purchasing power erosion due to depreciation that we have seen in the past year. However, when you invest in Eurobonds, it solves this problem by anchoring your capital, that's the money you invested, firmly in the US dollar. You are essentially creating an automatic protection against the domestic inflation and currency devaluation that we experience. And like I said earlier, they pay out fixed coupons twice every year. Having a guaranteed cash flow of a stable currency that is totally isolated from local market chaos is a massive advantage for your financial security as of today. When you're ready to invest, you generally have two main parts, the sovereign or the corporate. Let's look at what the 2026 figures are saying. I'm going to bring an example from both sides. On the sovereign side, which is the government in this case, we have FGN Eurobonds issued by the DMO to finance the 2025 fiscal deficits. These are backed by the taxing power and national reserve of the federal government, making them a lower relative risk. And currently, the 2036 maturity is yielding about 8.63%, and while the 2046 maturity sits at 9.13%. Now let's look at the corporate side. We take a look at the example of Seplat Energy. They issued a $650 million bond maturing in 2030 to fund operational expansion. This yield, in the case of the corporate, is slightly higher at 9.125%, but carries moderate risk. It is heavily backed by the company's revenue and oil and gas assets, and in this case, not the government. Let's take a look at what the Q1 2026 market snapshot looks like. The market for African Eurobond is incredibly bullish and highly liquid at the moment. As of February 2026, Nigerian Eurobond benchmark yields stabilized at around 7.02%, and this points to a robust confidence from investors. Let's look at it on a global scale. The recent $2.35 billion dual tranche sovereign issue pulled in $13 billion in global demand across 5 different continents. It simply means that it was 4.5 times oversubscribed, and this translates to a highly liquid secondary market for retail investors. Before we go too far, I need you to understand the risks that are involved in Eurobonds. High yields in Eurobond exist because they carry a risk premium, so you need to be aware of the default and credit risk. For instance, servicing Nigeria's debt currently eats up roughly 61% of projected federal revenue. While you earn comfortably in dollar, the government earns in Naira. If the Naira drops drastically, it is their burden to pay you back in dollar, regardless of what the market says. And finally, be mindful of the interest rate fluctuations. So if you hold to maturity, your return is fixed. But if you have an emergency and you need to sell early in the secondary market, shifting global rates might cause the price of your bond to fluctuate. And you know, I've always spoken about emergency funds. In any investment you want to do, always have emergency funds. Don't go all in if you do not have any emergency funds. So now we understand the risk. Where and how can we buy these Eurobonds? The first thing you need to do is to open a dollar domiciled account with a Nigerian commercial bank. This will help you facilitate the transaction and receive your semi-annual dollar coupons. The next thing you need to do is to choose which vehicle you want to use, sovereign or corporate. At the same time, you need to understand which market you're buying from. Are you buying from the primary market with a massive minimum of $200,000, or you want to buy from the secondary market, which involves contributing into a Eurobond mutual fund that is eventually used to buy institutional size bonds. And in the end, you simply deploy your capital and let the asset manager handle the rest. Let me tie it all together with this practical case study. I need you to pay close attention to the figure on the right. Imagine you allocate $10,000 into the Nigerian 2036 sovereign Eurobond at that 8.63% fixed coupon. Your base yield guarantees you $863 in hard currency every single year. Now let's get to where the FX impact flexes its muscles, right? Look at scenario A. If the exchange rate stays at 1,500, assuming it's 1,500 Naira to a dollar, your annual income would be 1,294,500 Naira. Now let's look at scenario B. If the Naira depreciates to say about 2,000 Naira, these are arbitrary figures. So if it depreciates to 2,000 Naira to a dollar, your dollar stays the same, but your local purchasing power jumps to 1,726,000 Naira. That's a 33% increase in local income, entirely generated by FX, and it requires zero efforts from you. That's the power of positioning in a much stable currency. So here are some key lessons I want you to take from this video today. One, that the Eurobond allows you to anchor your money in a dollar-dominated investment, protecting your money from local inflation and currency depreciation. You also get predictable cash flow twice every year. There are two types. The Eurobond can be corporate, it can be sovereign. So you need to analyze your risk appetite and decide which of these bonds you would like to go for. And finally, do not forget the risk. There are risks attached to every form of investment. So analyze the risk and be sure you really are ready to go into this kind of investment. Also, note that past performance do not guarantee future results when it comes to this kind of investment. And if this breakdown gave you some clarity about Eurobond, hit the like button, subscribe to Watch This Spaze, leave your question in the comments below, and I'll be glad to take them. Let's keep building. See you in the next video. Cheers.